presentation is going to be about CPM Group's outlook on the gold market. So let's start here with prices. As you can see on the chart on the right-hand side of the slide, we anticipate gold prices to soften from levels that we've been seeing since 2011. For 2012, we forecast gold prices to average around 1640, and in 2013, we expect gold prices will average on an annual basis around 1560, which is around $10 lower than the annual average in 2011. Despite this decline in annual average prices, when you look at the gold price, it's significantly higher than levels that it's been at historically, which you can see in the chart on the left-hand side of the slide. So even if we are forecasting prices of 1560 next year on an annual average basis, that's still fairly high when you look at prices over the last 50 years in gold. The most important factor driving gold prices is investment demand. Investors have been buying large amounts of gold over the past several years. Some of those reasons I've listed here on this slide. Investors are aware that a lot of these problems are going to take several years to be resolved. And as a result of this, investors are expected to remain interested in buying gold and owning gold. They are, however, not expected to buy gold in a rising price environment. Instead, they're expected to wait for gold prices to soften, stabilize at slightly lower levels from where they are right now before they step in as buyers. This we expect would weigh both on net investment demand for gold as well as on the price of the metal. This chart shows us the net investment demand for gold. And as I mentioned on the previous slide, there's a substantial amount of investor buying for gold over the last several years, which has been responsible for driving gold prices higher over this period. In 2012 as well, we expect strong investment demand. We believe that a lot of this is likely to come in during the second half of the year when gold prices have declined from levels that we saw in the last few months. Next few charts help us to make the point that investors are sort of holding off on making fresh gold purchases at current price levels. What you're looking at here is monthly US Mint gold coin sales, and the shaded region shows the sales been made by the Mint to dealers as of 2012. As you can see, there's been a substantial decline in these sales in relation to, say, 2009, 10, and even 2011. These charts show the premiums on those gold coins since the beginning of this year. And as you can see, they've been declining, which sort of suggests weakening investor demand and at the prices that gold was at during the first quarter of this year. This is an extremely small segment of total investment demand. It accounts for about 3% of total net additions made to investor gold holdings. However, it gives us a sense of what investors are doing in terms of buying gold as an investment asset. This chart shows us, the larger chart is the total gold held by physically backed exchange-traded products. As you can see, the total holdings are near record levels. The small inset chart shows us the net additions made by investors on an annual basis. This has been in a declining trend since 2010, which again reflects that higher prices have been discouraging investors from increasing their holdings. During the first 4.5 months of 2012, investors have added about 1.3 million ounces of gold. We expect that by the end of this year, they'd add around as much gold to holdings as they did in 2011. With that, we move on to official transactions. Official transactions essentially refers to the buying and selling done by central banks. Central banks have turned net buyers of gold since 2008. Prior to that, for nearly 4 decades, they've been selling gold. We expect the trend of net buying to continue in 2012 and into the foreseeable future. One of the reasons why central banks have turned net buyers is because they're trying to diversify their large foreign exchange reserve assets away from foreign currencies into with gold. This chart shows us the gross additions and gross reductions in central bank gold holdings on an annual basis. And the trend is fairly clear since 2009. What we're seeing is a decline in gross additions. Again, we believe that's largely in response to the high price of gold. However, what we've also seen is a faster and a sharper decline in the gross reductions, which is why we see a net increase in central bank gold buying. The largest buyers of gold among the central banks are those of developing economies. Developing economies have been growing at a fairly rapid pace. Many of them have trade surpluses, and as a result of that, they've accumulated large amounts of foreign exchange reserves. In recent years, we've seen that they've become increasingly nervous about the value of these foreign exchange reserves, especially the US dollar and the euro. As a result of this, you're seeing a lot of these central banks move away from holding these, or at least diversifying some of these foreign exchange reserves with gold. If you look at the chart on the left-hand side, that shows you how dramatically the foreign exchange reserves in these developing economies has risen over the past decade. It's gone from about under $1 trillion in 2001, 2002 to nearly $7 trillion as of last year. The chart on the right-hand side shows gold buying by central banks. The lighter shaded region of that chart is gold bought by developing economy central banks, and as you can see, they've been the ones who've been buying all of this gold. Well, as what you're seeing in the case of the developed economy central banks is that they have largely stopped selling gold. So that's basically had a positive impact on central bank gold holdings. This chart shows us the gold held by some of the larger developing economy central banks, and the percentage signs on top of each bar is the value of that gold as a proportion of the total reserve assets. On a global average basis, in 2010, gold as a proportion of total reserve assets was about 12.6%. And at the end of last year, it was about 14%. But as you can see, in the case of most of these countries, they're below that global average. We did a small calculation on if each of these central banks increase the amount of gold they hold by 0.2%, that would result in a 6.8 million ounce increase in demand from central banks, which is pretty large for the gold market and would have a very price supportive impact. With that, we move on to fabrication demand. The largest component of gold fabrication demand is jewelry. Around 83 to 85% of gold fabrication demand comes from the jewelry sector. It's an extremely price sensitive part of gold fabrication demand. It has an inverse correlation of about 0.76 against the price of gold. Based on our expectations that gold prices would soften over the next few years, and the fact that there is a strong inverse correlation between the price of gold and gold fabrication demand, we think that, or we forecast that gold jewelry demand would increase in the medium term. Other important components of gold fabrication demand are the electronics sector, which is not price sensitive like the jewelry sector. And we expect that demand from this sector will also increase over the next several years, largely as a result of a sheer increase in the number of electronic items being produced and the usage of gold in these electronic items. Another source of demand for gold is the dental sector. There is some price sensitivity in this sector. There is some substitution with relatively cheaper metals such as palladium and silver. However, each of these metals has very specific characteristics due to which the amount of substitution does get limited beyond a certain point. These two charts show the total gold demand in India and China, currently the largest consumers of gold. In 2012, we expect demand from India to decline, but still remain at extremely high levels. This decline in demand we expect would come from the weakness in the Indian rupee against the US dollar. Right now it's at record low levels against the US dollar. And this is important from a domestic demand point of view because nearly 70 to 75% of Indian gold demand is met by imports. So a weakening rupee would typically make it more expensive for buyers or consumers in India. In addition to that, for the fiscal year 2012-2013, the government has increased import duties. So a combination of a weaker rupee and higher import duties is expected to weigh on demand. That said, the weakness in gold prices that we are seeing right now and that we anticipate to continue seeing in the medium term is expected to help boost fabrication demand in India, or total demand in India. And so we expect about a 8.5% decline in total Indian demand in 2012 compared to 2011. In the case of China, it's slightly different. We expect to continue seeing the sharp increases that we've been seeing in demand over the past several years. China doesn't have any of the issues related to import tariffs. It produces a lot of its own gold, and it also has a currency which is fairly strong against holding up pretty well against the US dollar. So we expect that demand in China would continue to rise in 2012 and possibly reach parity with the Indian demand as of 2012. With that, we move on to supply. The rising price of gold over the past several years is expected to has been boosting supply and is expected to continue boosting supply in the medium term. One of the primary drivers of this increase is expected to come from mine supply. The increase that we've seen in prices over the past several years have helped to bring a lot of new projects on stream, and a lot of new projects are expected to come on stream over the next several years, which is expected to boost this mine supply. We've also seen an increase in secondary supply. In 2012, it's expected to be flat from 2011 levels. However, it nearly doubled in the last few years. So that's still a very large amount of secondary supply coming for gold. The rising price of gold has had a positive impact on the amount of exploration dollars being spent on gold mining. These bars essentially show the total amount of exploration dollars being spent in the mining industry. And the shaded region shows the amount that's been allocated to gold mining. Pretty much since 2002, about 40 to 45% of money spent on exploration in the mining sector has been diverted towards gold mining, and which is one of the reasons why we expect mine supply to rise going forward. The chart on the left-hand side here shows us the production-weighted cash cost and the production-weighted production cost of gold mining against the gold price. And it's pretty clear that there are extremely healthy margins that are earned by mining companies that are producing at this time. The chart on the right-hand side shows that more explicitly. On an annual average basis, the margin between cash costs and the gold price was about a little over $900 an ounce. So this shows how profitable gold mining has been in recent years, and also explains why there's this increase in gold mine supply expected in coming years. Just to put that in perspective, if you look back historically, the margins were a lot smaller back in the 1990s when the price of gold was lower. You had margins between cash cost and the price of gold at around $100 an ounce, which has now gone up to a little over $900 an ounce. This is the cash cost curve for primary gold producers in 2011, and about 90% of gold output was produced at cash cost below $947 an ounce, while the average price of gold last year was $1,570. This is the impact of all that increase in exploration spending as well as cash costs, the healthy margins between gold prices and cash costs. We expect a large amount of new additions to global mine capacity over the next 10 years. The post-2015 period is for the years between 2016 and 2021. This chart shows the cumulative gold production, which surpassed 5 billion ounces last year. Jeff spoke a little bit about how this data has been developed both for gold as well as silver. A large portion of it has really come on stream since 1900. The bars on the right-hand side show how this gold has been allocated, or how we believe it's been allocated. There's about 1 billion ounces held by central banks, about 2.3 billion ounces held in jewelry, about 1.5 billion ounces held in private stocks, and about 10% of it we believe is either in some sort of fabricated product or cannot be identified, so it's probably misplaced. So that complete my presentation and open it up for any questions. Yep.
Clearly, in the last 10 years, the increase in gold production has come from China. Is that likely to increase at that level going forward?
We expect global mine production to increase going forward, largely because of the margins that we've seen between cash costs and the price. So we do expect gold mine production to continue rising over the next several years.
What's the correlation between the gold price and the European currency decline in respect to the financial crisis in Europe now? How do you see that going forward?
There has been a positive correlation between those two, and that's largely because of the inverse correlation that we've been seeing between the US dollar and gold. So any strength or weakness in the euro would typically result in a similar strength or weakness in gold prices. How do we see that? If the euro continues to decline, which it probably will if things, if the macroeconomic picture in Europe deteriorates further, that would probably weigh on gold prices, at least in the short term, and then there would be some amount of safe haven buying which would be supportive of gold prices. So to some extent there is a correlation, but eventually the fundamentals of gold, because gold would show up as a safe haven asset, you would see some support for gold prices.